how the potential tax reform can help you and your portfolio. Stay tuned for more details. Hello, this is Michael Loftus, Loftus Wealth Strategies and Wealth and Wisdom TV, where education is the key to a successful financial future. With that in mind, excited to have our second part of our interview series. We have a great speaker today, somebody who really has a pulse on what's happening in Washington. And yes, of course, how it can affect your portfolio, both positively and negatively. Stay tuned. Okay, welcome back to our second series of interviews. Something new we're doing here. Very excited today to have Bill Cass from Putnam Investments. He's Director of Wealth Management Programs at Putnam. You have his full bio below in the Show More section, as well as information on Putnam and all of their offerings. So, welcome.
Great to be here. Thank you, Michael.
Thanks. Here we are. If you can't tell, we had a meeting today. We've got a golf course in the background. So if anybody walks by, it's not our fault. So let's get right to it. Had Bill down here in sunny southern Delaware. And our topic today is Washington. Now, we're not going to talk politics. We're going to talk about some things happening in Washington that can affect our listeners, viewers, and clients. So the big thing is, we know that yesterday, for now, healthcare is pretty much DOA. Correct. Nothing's going to happen. So now the big focus going forward is tax reform. And I would say that this is a must win for the administration after not getting health care done. So let's talk about, Bill's relationships on Washington. This is what he does. He can cut through all that stuff and give us the straight on the potential tax reform coming out. With
the caveat that it's a very fluid situation, like healthcare,
Washington, right?
and highly unpredictable.
Yes,
just setting that stage and setting that expectation right up front. So the attention turns to taxes. That doesn't mean that there hasn't been any work behind the scenes being done on taxes. There have been committee meetings and hearings, and a lot of work that's gone into place already. Now that will become more public, now that the healthcare situation has played itself out. I would expect on tax reform, I would expect more details to emerge probably after Labor Day. I think between now and Labor Day, you'll hear about a fiscal year 2018 budget resolution being passed or attempted to be passed in Congress. You'll hear more about that. That's sort of a first step. Any type of tax legislation, that type of the tax reform bill will be tied to that budget resolution. This is just part of a sort of an arcane process in the Senate called budget reconciliation. So I would expect more details to emerge in the fall. One of the questions, Michael, I get on my travels is, okay, will they be able to pass a bill? And if so, when would changes actually take effect? And there's some commentators out there that think there is a chance that you could actually have a bill be passed and changes retroactive to the beginning of 2017. I don't subscribe to that personally, but there are a few out there. I would think, based on my baseline, would be that any changes, if they do happen, would be effective the beginning of 2018. Okay. So obviously, how does it affect our viewers? I think that number one is going to be tax brackets. So what do you see coming from that? Right. So when you talk about tax reform, there's a few things coming into play there. One is you are collapsing the tax brackets. You don't have so many tax brackets. Maybe you have 3 tax brackets. You lower the overall rates and you get rid of deductions. So let me talk about rates at first here. So right now, the top marginal tax rate for ordinary income is 39.6%. It's not including the Obamacare taxes, but let's call it 39.6%. The highest rate after a tax reform bill is passed would probably be maybe 33%, maybe 35%. So you'd probably have 3 brackets, a top rate of maybe 33 or 35%. But the big question that I have is, what about the deductions? If you lower the rates, that's going to cost the government money. There has to be a way to offset that lost revenue, and that's where deductions come into play, Michael.
So with those deductions, I'm hearing a couple different things. Today, what is it? Each individual gets $6,000. So a married couple, standard deductions, $12,000. So you know, I hear deductions as a small business owner, and that's one of my favorite things. You know, one of the few positives I can get. So what does that look like going forward?
Well, I think many existing deductions, exemptions, credits would be eliminated. Frankly, there's two major deductions that they've talked about retaining in the tax code. That's mortgage interest and that's charitable contributions. So there's a big push to retain those. However, I think even in a new world, even if they're retained, I think they'd be scaled back a little bit. So that's sort of the negative side. The positive side is that you would, at the same time, probably increase the standard deduction. So for people that aren't itemizing and keeping track of all those individual deductions on their tax return, you would double the standard deduction, which would be hugely beneficial, or thereabouts.
So have you seen any models where, you know, retirees or individuals, right, making $75,000, $100,000 range, is it better for them? I mean, is it definite a little bit?
For many people, it would be better. The people that wouldn't benefit as much would be if I live in a state where I pay high property taxes that I write off today, and also I have a high state income tax rate like they do in California, or maybe even New York. I might not benefit I definitely probably would not benefit as much because I would be, in this proposed model, I would be losing those write-offs. Conversely, maybe retirees who are not itemizing deductions on their tax return anyways, because they paid off their house, they're not writing up mortgage interest, that raising of the standard deduction might be hugely helpful to those folks.
So it seems like middle America is taken care of, and the wings, so to speak, California, New York,
not so much. Again,
not going to be happy.
High state income taxes, high property taxes would would likely be impacted.
So how about from an investment standpoint for clients that have monies outside of their retirement plan? You know, we're not buying and selling, but let's face it, you got dividend distributions, you might be capital gains, so you've got, you know, we used to call it LIDs, right? Long-term income, dividends, short-term gains, right? LIDs. So how does that look?
Well, I don't think there would be a huge change there in terms of the structure, meaning that today you benefit from a preferential tax rate on long-term capital gains and dividends. In all the proposals that I've seen, that largely would continue. There might be a difference in the way the math works. Like one of the proposals, the House Blueprint Plan calls for taxing investment income, so for example, dividends, capital gains, the same as ordinary income. That doesn't sound so good, but with the caveat that you'd be able to exclude half of it. So for example, if you're paying a 33% ordinary income tax rate on a marginal basis and you had a long-term capital gain, you would pay that same rate, however, you would be able to exclude half of it. Your effective tax rate would be half of 33 or 16.5%, which actually would be more beneficial based on what it is today. I don't know how the numbers will work out, but I wouldn't expect a major philosophical shift in terms of taxing dividends and long-term capital gains at this point.
So how about, you know, I heard a lot last year with the old administration and obviously change. There's two areas. One is stepped-up basis. So stepped up basis, when you pass on your assets. So if you have $100,000, it's worth $2, you pass it on at $2. Pretty nice deal.
It's a huge benefit.
Yeah, huge benefit. I'm hearing now, other administration, I was hearing there's going to be caps and all this other kind of stuff. What are you hearing there?
We don't know. We really do not have any clarity there. I will say what our feeling is, you know, there's certainly a push to fully repeal the federal estate tax. So if you repeal the federal estate tax, can you make a case to have full stepped-up cost basis? Because that's sort of the reason why you have stepped-up cost basis in the beginning, is to offset kind of the negative impact of a federal estate tax. So the case for having full step-up is challenged at that point. I personally think I don't think full stepped-up cost basis at death would be eliminated across the board. But certainly you could look at some type of limitation for some taxpayers, maybe at higher wealth levels. So that's obviously something we're going to be watching very closely.
Didn't prepare you for this one, but another thing I heard last year was stretch IRAs, de-seeding IRAs to continue on.
Right.
The old administration was trying to, he called it a loophole, was trying to take that away and basically give you lump sum or 5 years. Any word on that at this point?
No word on that. However, I will say this. Anytime we see a piece of, like a budget bill or some type of comprehensive tax law changes, we're always looking under the covers to see what could be buried there. The last budget bill that was done in 2015, certain claiming strategies for Social Security were eliminated. So you never know what's going to be thrown in there. I would not be surprised if we saw a scale back of stretch IRAs, so that once the IRA is left to a non-spouse beneficiary, they'd have to fully withdraw those funds within 5 years and pay taxes. So that one I would say is certainly at risk of being eliminated.
And we'll have links below on that topic as well. So again, this has really been helpful. I think that we all watch and read, but there's a lot of noise out there these days. It's great to get somebody who's out there working with some sources in Washington to help better educate us. So again, we have Bill Kess from Putnam Investment today. Thanks again, Bill. Really great opportunity to have you down in lower, slower Delaware.
Great.
Okay, down by the beach, of course. But this is Michael Loftus, Loftus Wealth Strategies and Wealth and Wisdom TV. Hope you enjoyed that. Really have an opportunity to bring some insightful ideas and thoughts from somebody who works closely in Washington. If you like this, watch for next week. We will have part 2 of our interview with Bill Kess. Thanks for watching.